For 2 decades, big tech ran on one rule: asset light, cash rich, infinitely scalable. That rule just broke. We are watching the largest physical infrastructure build out in the modern economic history, and it's being financed not with the cash but with the debt. Today, we are decoding the macroeconomic transition from asset light software to the debt funded heavy industry, and the three signals that will tell you when this cycle will turn. AI capex versus the historical infrastructure. Four things are happening at once. First, AI capital expenditure is now running at roughly 2.1% of the GDP, on par with historical infrastructure supercycles. Second, Jevons Paradox is active. As token cost collapse, total spending doubles, not shrinks. The third is hyperscalers and their partners are executing a literal gigawatt scale physical build-out, exemplified by Oracle and OpenAI $300 billion infrastructure deal. Fourth, the tech sector is abandoning its asset-light playbook entirely, banking on $1 trillion to the finance physical scale. Historical GPT investment in the context. Let's put 2.1% of the GDP in historical perspective. The Louisiana's purchase ran around 3% of the GDP. US Railroad in 1850 was about 2%. The Interstate Highway System 0.43%. The Apollo Space Program 0.4%. Big Tech's projected 2026. AI capex sits right alongside these general purpose infrastructure shifts. The diagnostic synthesis here is simple. This is the fourth industrial revolution's physical foundation, and like every prior one, it demands a massive economy-wide infrastructure built before the productivity gains materialize. AI capex growth trajectory. Area comparison. The growth curve is staggering. AI capex has gone from around $20 billion to $700 billion in just a few years. Roughly 75% or $540 billion goes directly into the physical infrastructure. To visualize the scale, hyperscaler capex of $720 billion is now approaching the GDP of countries like France or the UK and closing in on Switzerland and Saudi Arabia. The Jevons Paradox engine. Here is the mechanism driving all of it. Efficiency gains, token processing cost dropping over 80%. Reduce total spending. Instead, they expand viability. Lower cost means automated workflows and mass scale generation become economical for far more use cases. The result is exploding demand. Total token consumption skyrockets. This mirrors exactly what James Watt's economist namesake identified with the steam engine in 1865. When something gets dramatically more efficient, you don't use less of it. You find way new applications that total consumption explodes. The AI capability squeeze frontier versus the edge. There is a tension brewing inside this boom. Frontier's models are centralized, gigawatt scales data centers, requiring 4.5 gigawatts of the capacity packs, high marginal cost, centralized API pay per token. Small and edge models are decentralized, capable of running locally on devices with cloud reliance. And by 2026, sub 8 billion parameters model hit the performance threshold that took years to develop. This creates the API half-life problem. If localized models can handle 80% of the enterprise use cases, the economic justifications for paying per token to centralized hyperscalers starts to shrink. The Oracle-OpenAI Capital Alliance, the Mutual Survival Pact. Now let's get specific. This is the deal anchoring the entire sector. Oracle's input providing the 4.5 gigawatt of continuous compute capacity via Oracle Cloud Infrastructure. OpenAI's input guaranteed revenue stream to justify Oracle massive capex. The deal matrix is $300 billion total contract value, a 5-year commitment beginning in 2027, worth roughly $60 billion a year in compute lease payments. The strategic call out here is critical. This is not a standard software lease, it is a legally binding mutual survival pact. Oracle takes on serve counterparty risk to finance the build, while OpenAI takes on existential compute risk. Stargate is expanding towards 7 gigawatts of planned capacity over $400 billion in total investment. Physical sites are spreading across the US, Abilene, Texas, and the flagship campus, plus New Mexico, Wisconsin, and more. Funded through a combination of the course infrastructure financing and the project loans. The Oracle and OpenAI power scale 4.5 gigawatts. Let's make the number tangible. 4.5 gigawatts equal to the continuous power draw of roughly 4 million homes. This is the grid reality check. Cooling requires liquid, cooled racks for the dense GPU clusters. Generation requires the Abilene site to draw dedicated gigawatt scale power, and the constraint is that data centers are increasingly outpacing traditional grid build-out located in areas with available industrial power. Dual pathways of compute demand. OpenAI is hedging across two paths. Path A, off-the-shelf, purchasing NVIDIA Silicon, deploying hundreds of thousands of GB200 GPUs through Oracle pipeline right now. Path B, custom silicon, co-designing custom chips with Broadcom, moving from a long-term contracts to first deployment targeted for 2026, scaling toward 10 gigawatt custom silicon footprint by 2029. While Oracle funds the immediate NVIDIA GPU pipeline, OpenAI financial telemetry burn versus the fuel gauge. Here, where it gets uncomfortable. Track 1 is the burn compute commitments exploding towards $60 billion a year, generating roughly $20 billion in operating losses at peak. Track 2, the revenue gauge. Annualized revenue around $14 billion, projected towards $20 billion. Track 3, the fuel tank, a roughly $40 billion funding round from the SoftBank closed in March, plus a war chest near $122 billion, the takeaways. OpenAI is growing aggressively, but profitability remains years away. And that $122 billion war chest is the critical bridge to the targeted Q4 2026 IPO. OpenAI strategic alliances. The free-me ecosystem. OpenAI isn't operating alone. It's tangled in a web of free-me relationships. Microsoft's Pivot, now providing roughly 27% of the AI of OpenAI computes, while increasingly building independent AI infrastructures of its own. SoftBank's deep pockets roughly $30 billion in the equity invested into OpenAI, funding the GB200 compute orders and a Stargate campus. Amazon's dual rule, roughly $38 billion cloud compute commitment, alongside an equity stake of its own. The Synthesis cloud hyperscalers are simultaneous investors, partners, and the direct competitors in this ecosystem. And here is the next thing. The tech sector's structural shift cloud software to the industrial utility. Step back and the entire sector has morphed. The cloud era, asset-light, cash-funded, and infinitely scalable with zero marginal cost, 80% plus gross margins, debt to equity historically sustainable around negative 40%. And the AI infrastructure's era, asset-heavy debt finance project loans, constrained by raw physical power and still brutal 3 to 5 year chip obsolescence cycle, debt to equity leaping toward a projected 83% by 2026. The tech sector has fundamentally morphed from an asset-light software business into a high fixed cost depreciation, heavily industrial utility. Nearly $1 trillion in the big tech AI debt. The financing tells the same story. The tech total AI debt is approaching $1 trillion, up from far a smaller base just a few years ago. This is built through the corporate bonds, GPU-backed asset securities, hyperscaler debt, and syndicated project loans finances. And there is a rating agency warning it's significant. Moody's had flagged the Oracle's leverage could put its credit under pressure. The synthesis to finance the AI supercycle. Big tech has taken on unprecedented leverage. The sector's balance sheet now carries the systematic risk profile of a heavy industry. And here is what to watch. Trade signals going forward. The liquidity event OpenAI's targeted Q4 2026 IPO at the reported $1 trillion valuations would open public market access for ongoing infrastructure capital. The efficiency threat. Anthropic reaching roughly $30 billion ARR with a greater capital efficiency could challenge whether gigawatt scale debt heavy economic models remain optimal. Custom silicon economics. Broadcom's custom chip arriving in the second half of 2026 would successfully break Nvidia's margin lock-in. As Elon Musk put it back in February, mark these words, the most economically compelling place to put AI may eventually be in space. So, the era of the asset-light digital cloud is over. The next decades belong to the physical steel, gigawatt power, and the deep industrial engineering. Thank you. See you in the next video.